Among secondary markets in the South, Greenville and Charleston, both of South Carolina, have been two of the strongest performers in terms of revenue growth. But that success has not translated to the Palmetto State's capital, Columbia. Welcome to Apartment Market Dynamics from MPF Research. I'm Jay Parsons with your Columbia update. Since the rebound in the apartment sector began in the early parts of 2010, we've seen some good occupancy growth in Greenville and in Charleston, followed by some good momentum in pricing. But we've yet to see progress really kick into gear in Columbia. Let's start with the occupancy story, and we're going to show you three lines here. Columbia is in purple, Greenville is in green, what else we put that one in, and Charleston is red. And what you see that occupancy isn't really great anywhere, but it's pretty good, around 93% in both Greenville and Charleston. Greenville actually peaked last year, as you can see, and we've seen it slide a little bit since then. It's due to some strong rent growth. We've talked about that one earlier. But in both of those markets, occupancy rates are well above where they were during the downturn. But then there's Columbia, and this is one that's just been putzing along in the recovery process. Occupancy fell as low as 88% in the downturn, and as of 2Q, it's at just 90.3%. Very weak in the national picture, and you see occupancy has fluctuated a good bit recently, got as high as 91.9% in 3Q of last year, plunged to 89.3% over the next 6 months, and then got a 1-point boost in second quarter 2011. And it's worth pointing out in Columbia, like many parts of the South, that occupancy rates are better in top-end, newer product. When we look at apartments built in the past 2 decades, occupancy rates are around 93%. But when we look at apartments built in the 1970s and earlier, occupancy rates are terrible, in the mid-80s. And how about some submarkets? You see rates of 90% everywhere, but in one spot, Central Columbia University, occupancy is at 94.1% there, and that is up 2.6 points annually. And obviously that's a key submarket for a metro with a big university. And switching gears to pricing, let's look at annual rent change among South Carolina markets, and there's Columbia again at the bottom of the pack, growth of just 2.6% at a time when the national average is 3.8%. Greenville was actually one of the U.S. leaders in rent growth not long ago, but it's come back down to earth with a year-over-year increase of 3.3%. And Charleston saw a big boost recently, same-store rental rates jumping 5.2% in the year ending June. So, what's the problem in Columbia? Well, a big part of the story has been cutbacks in the government sector. Columbia is a state capital, so government is a big piece of the economy, and Columbia is the only one of the South Carolina markets that has yet to see annual job change turn back into positive territory. But if we take out the government sector and look only at private sector employment, we see that employment change is actually slightly positive, so that's good. Looking ahead to the forecast, Columbia should see a nice bump in third quarter. This is always a good time of year for college markets like this one as students come pouring back in for the fall semester. And longer term, it looks like government cutbacks are coming to an end, and with the private sector showing some employment growth, we should begin to see the Columbia apartment sector start to show some meaningful progress. So look for that in the year ahead. And that wraps us up for Columbia. Until next time for Apartment Market Dynamics and MPF Research, I'm Jay Parsons. Thanks for watching.
Want more? Go deeper with MPF Research's apartment market reports. From a national level, down to individual metros, to specific neighborhoods, MPF Research has been providing unparalleled apartment market intelligence to the multifamily industry for almost 5 decades. Learn more by contacting us at 877-284-4938 or visit www.npfresearch.com and click on Market Reports.